inflation is setting in, the government sucks money out of the system. If there is deflation that is setting in, what happens in that case? The government pumps money into the economy, right? So this is how do they do it? Again, by the interest rate mechanism. If inflation is more, interest rates are on lending, it goes up. Right? On lending, it goes up, and deposits are made attractive by increasing the interest rates. So, interest rate mechanism plays a lot of role in monetary policy. So, what are the objectives of monetary policy? Like I told you, it's management of inflation and unemployment. The key word here is management. You cannot take out inflation or unemployment out of the system, out of the economy. It is going to be there. It will be there, and many a times that is the byproduct of whenever you have free market economy, right? These are the byproducts. If you can't have ideal situation of prices, that is where like price equilibrium, demand equilibrium, or supply equilibrium, this position is not going to be there in free market economy, because there are different factors that are pulling up these, right? So in any case, inflation, unemployment, these are managed, right? Sometimes the unemployment goes up, you try to bring it down. Sometimes there is no employment, you try to push things up so that the employment rises. So these are the things that you need to take care of. Now, what happens in the case of if there is employment for all? If there is employment for all, my dear friends, and that is not to say that there should not be employment for everyone, but in that case, that's a very ideal situation that employment is available. If it is available to all, every person is going to spend, that is, more money chasing few goods. So somehow or the other, of course, the reasons for unemployment are not the macro indicators or these things. They are entirely different, right? Unemployment is not related with, say, the macro factors of economy. Of course, there are reasons for unemployment which are entirely different. So they are managed. One of the objectives of monetary policy is management of inflation and unemployment. Secondly, maintenance of currency exchange rates. If currency exchange rates are not maintained, that's what I mean to say. Maintained means if our currency is weak against a currency which is accepted worldwide, that is dollar in this case. So what do we try to do? We try to keep the value of dollar within our limits, right? So that whatever we import, they don't become costlier. And in our case, the major part of our expenditure or major part of our import bill is for petroleum products. So what do we try to do? We try to keep those imports relatively cheaper by constantly increasing the value of rupee, right? Now, how do you increase the value of rupee? You can increase the value of rupee by promoting exports, right? When you have more dollars within yourself, your currency becomes strong. Inherently, it becomes strong. That means you're making your exports viable, you're making exports more profitable. So in that case, that is what the mantra has been of this government. You promote exports. Or in other words, if you're not exporting, you manufacture within and you consume, right? So that is what we are trying to do, so that the exchange rate of dollar versus rupee remains stable and our imports, they are within our reach, right? So that are the prime objectives of monetary policy. Now, depending upon the objectives, right, monetary policy can be expansionary or contractionary. Now, what do you mean by expansionary monetary policy is? The aim of expansionary means you expand money supply. Contractionary, you take money out of the system. Here, you put money, you pump money into the system. Contraction, you take the money out of the system. That's very in simple terms, you can talk about it. So, what is the aim of expansionary monetary policy? That is, you want to put the economy on a growth mode, right? On the growth mode, on furthering economic growth, improve economic growth. There are two concepts, economic growth and economic development. Economic growth is generally taken care of within a particular year. That is, you try to take care of inflation, you try to take care of GDP, these kind of factors. Development, improve the quality of education, improve the quality of life, standard of living, all the qualitative parameters, they come under the development part. All the quantitative aspects which can be taken care of by tweaking certain variables, macroeconomic variables, they are taken care of in economic growth. So, when you say expansionary, it aims at furthering the economy. Contractionary, it aims at slowing down the economy. Now, it also aims, expansionary monetary policy also aims in increasing the money supply in the economy, whereas in contractionary economy, it aims at decreasing the money supply in the economy. Now, how do you do that? You want to increase money supply into the system. What do? You want to put more money into the hands of the public. You decrease the interest rates, right, on loans. So what happens? More money is there into the hands of the public to spend. Here, you increase the interest rates. The money is taken out of the system. Also, here in expansionary monetary policy, the government securities that are issued by government are purchased by central banks, right? Are purchased by central banks. Now, what happens in that case? If the securities that are introduced by government and if they are purchased by central bank authority, that is RBI, what happens in that case? Money comes into the hands of the government, which will be used for spending by government, right? To increase what? To increase employment, right? It will increase employment through various schemes like Manarega, right? That is money for work. It will try to do that. And also by lowering the reserve requirements of banks, right? Expansionary monetary policy, money supply can be increased by reducing the level of reserves which are to be held by the bank as mandatory. Now, what happens in that case? Again, this creates more money with banks for further credit creation, right? Every bank is supposed to keep certain money with RBI as mandatory. This level is brought down so that banks have more money within their hands to extend credit to whosoever they want. Now, what is doing this? Expansionary monetary policy, it is aiming at economic growth so that there is economy is on the growth mode, not on the development mode. Development takes place like this. Growth is always on the higher side. It's tilted towards the sky. Now, because of all this, what is happening? Money is coming into the economy. Since money is coming into the economy, people are spending, people are investing. Since people are investing, what does it lead to? It leads to decrease in unemployment. It stimulates business environment and increases consumer spending. People are spending, companies are investing, and because of all this, since people are buying, companies are investing, it creates a viable scenario for increasing the employment. So, expansionary money supply or monetary policy increases money supply to the system so that it facilitates economic growth. On the contrary, but here there is one flip side of expansionary monetary policy. Money is coming into the system quite freely. It's flowing, right? So what happens in that case? The flip side of this policy is that it may lead to inflation. More obviously, this is leading to a scenario where people are having more money to buy fewer goods, right? That are available. So it creates an ideal situation for inflation. Again, the government takes note of it and it suddenly goes for contractionary monetary policy so that inflation is kept under check. Now, contractionary monetary policy aims at decreasing money supply in the system. Now, how it is done? By raising interest rates, right? If you increase interest rates on loans, what happens in that case, and deposits? So what happens in that case? Money is sucked out of the system. There will be no investments. No investments, again, it may lead to unemployment, and also by money is taken out of the system by selling government bonds, right? Less money will be available. Money will be available with the banks. They will keep it aside with themselves. By increasing the reserve requirements, RBI may increase the reserve requirements of the bank. So what happens? The money gets blocked with them. So contractionary monetary policy is used, like I told you, when inflation has increased during expansionary monetary policy. So inflation is controlled by contractionary monetary policy. With respect to inflation, how it is used contractionary monetary policy? If you lower money supply, inflation is controlled. If you increase money supply, unemployment is controlled. And with respect to currency exchange rates, that will be discussed quite some time later. Now, expansionary monetary policy leads to increase in spendings by the public. Contractionary monetary policy leads to increase in deposits, savings that are to be made by the public. So, when you want money into the system, what do you try to do? You try to decrease the interest rates on deposits, right? So that people don't save, they spend. Here it is exactly the opposite. You increase the rates on deposits so that people save rather than spending. Now, these are the mechanisms to control the money supply. Monetary policy is predominantly for controlling the levels of monetary supply and frequency of money supply, not monetary supply. Levels of money supply and frequency, that is quantum of money supply and the frequency of money supply. Now, how do you do that? Interest rate adjustments. Now, interest rate adjustments, interest rates are regulated by central bank authorities, that is the RBI. It is the authority that increases or decreases the interest rates. Now, how does it do that? How does it happen? Now, whenever certain money is kept with the bank, right? This money which is kept with the bank, they are provided interest rates. So, the base rate, the lending rate, right, that is required, lending rate, money that is being lent by RBI to banks, that lending rate is either increased or decreased with respect to the phases of business cycles or the phases of the economy, right? If there is a recession that is setting in, what happens in that case? The interest rate that is charged by RBI for short-term loans that have to be taken by banks, they are reduced so that banks avail that loan and send that money back into the system, and the recession is taken care of. Now, how is the mechanism? Increase the lending rate for banks. In other words, the exactly opposite of what I told just now. If you want to push the economy, you decrease the lending rate. If you want to control inflation because of expansionary monetary policy, what do? You increase the lending rate. So what happens in that case? The borrowings cost, it goes up. The same would be recovered from customers, right? If the cost of borrowing it goes up, obviously the customer is the last person who is spending, which makes the customer not to spend, and it makes them to rather save, right? And hence it leads to reduction of, if you want to reduce money supply, you increase the interest rate. If you want to increase the money supply, you decrease the interest rate. That is what we mean to say by interest rate adjustments. Change reserve requirements, right? Now again, it is mandatory on the part of banks to maintain certain money as reserves with themselves, right? So whatever these reserves that are being maintained by banks with RBI, they are given certain interest on that. Now that is not the case. That is not the issue that we are discussing here. What we are trying to understand is that by changing the levels of reserves that are supposed to be maintained by banks, you can control money supply. That is, if you say that this much percentage is mandatory for banks to maintain as reserves, that is, it is idle money, IDLE. Which money is that? IDLE, idle money, money which is not being put to productive use. Why? Because it is the money that is to be kept aside by banks as reserves, mandatory. Now, in those mandatory levels, if the levels are brought down, that means what? There is more money that is available with the banks. More money can be pushed into the economy. If the levels, if they are risen high, if they go up, if they are made to mandatory 6% say of the deposits, if it is increased to 8%, even the mere 2% has a very direct impact on the quantum of money that is supplied by the banks to the public, because money is getting blocked, it is made idle. So to influence money supply, you change your reserve requirements, the mandatory reserve requirements. Now, if the levels are increased, commercial banks find less money. If the levels are brought down, commercial banks find more money to lend, and accordingly, the interest rates are taken care of. Open market operations. Last one. The central bank can either purchase or sell securities issued by government to affect money supply, right? For example, central banks can purchase government bonds. Because of that, banks will have more money, right? Banks will have more money to increase the lending and money supply in the economy. Now, how is it? Central banks purchasing government bonds means what? That money is coming back into the economy, into the system, and hence there will be increase in money supply through banks, right? Through banks. If it is purchasing government securities from the open market, so definitely the money is coming back into the hands of government for spending, and ultimately there will be increase in money supply. So it's very simpler to understand, unless if you are following the lectures on a regular basis. Now, how do the interest rates affect? Let me have a very brief understanding about that. Interest rates, they play an important role in the process of economic cycle of expansion and recession, right? If you remember, when the economy is in the recession mode, interest rates are brought down, if the economy is developing, if it is growing in the growth phase, if it is reaching the peak, at that point of time, the interest rates are increased, if it is increasing. Like, it is very simple. If people are facing hardships, they are provided relief with decrease in interest rates. If people are having ample amount of money at their disposal, more than what they need, of course, the interest rates are increased so that people don't have money. Now, interest rates are the results of interaction of supply and demand of money, right? If you need money, if there is available, definitely the situation might be ideal. You need money, there is not demand, the interest rates goes up. If there is no demand, if there is more supply, interest rates will come down. So it is the price of liquidity. You can say interest rates are the price of liquidity. So when recession sets in, demand for liquidity increases, right? Demand for liquidity, thus firming up interest rates. So whenever recession starts to set in, you need more money in your hands. So when you need more money in your hands, the interest rates obviously they go up. When you reach the lowest level of recession at that point of time, that is the moment when you start having signs of growth. So when you have signs of growth, obviously the interest rates are brought down so that more money is there in the hands for investments. So these are mechanisms that the central bank or the RBI in our case plays for money supply. That's all for now. Take care. Thank you.